and welcome everyone. It's 12 noon in Atlanta, Georgia. My name's Ted Steinkamp, and I am with Advanta IRA. I'll be today's host of the webinar. And down below here is my contact information if you should have any questions about the presentation today. But as we continue to move forward, just a couple of quick things here. Let me just go through a couple of disclaimers as it relates to the webinar today. Just please be aware, we don't sell any investment product as a company, and we certainly do not provide tax, legal, or financial advice. Please consult with the proper advisor before you invest in any product. What I wanted to do is just go through a few slides here, just kind of reintroduce a few things about Advanta IRA before I bring on our speaker today, Trevor Thompson. Just a couple of quick facts about Advanta IRA. We've been around as a company for over 20 years. We currently have over $3 billion in assets under administration. And with all the cash balances that we may hold within an IRA account here at Advanta IRA, that cash is held within inside of FDIC insured institutions up to the applicable limits. Everything else that we have in the accounts are simply bookkeeping entries of your investments that you have subscribed to or are holding with a depository, etc., and the paperwork that backs it up. Those cash is the only financial asset which we need to keep in a secure location. The other aspect is the people side of our business. We're very proud to have people plugged into all processes of our business, and we like to see them shine. That's why we have dedicated account managers that provide concierge style service. And of course, we have all the educational tools that we maintain on the website for your use. So feel free to access those when you wish to do so. Quick question that we hear quite a bit is what is a self-directed IRA? And the most simplistic way in which we explain it to interested people is it's really a unique investment approach where you can invest in physical alternative assets, and you can hold these in a tax-free account like a Roth IRA or a tax-deferred account like a traditional IRA, SEP IRA, etc., and just basically receive faster, hopefully, what will be faster investment growth than over traditional methods of investing. Now, what can you hold within the self-directed IRAs? Well, really, you can hold quite a bit. And I'll talk a little bit about these in a few moments, but really, if you look at the bottom of the slide, the bullet points, these are your more traditional things that can be held inside of an IRA. The creativity is really endless. As long as it's not a life insurance contract or what's considered to be a collectible, like baseball cards, art, fine wine, those sorts of things, you can hold it inside of a self-directed IRA. And as I said, the creativity is endless. There was one gentleman I was speaking to last week. He intends to purchase within his self-directed IRA 30 and 40-yard construction waste dumpsters and lease those out. That's just an example of the creativity. We've also seen some clients that purchase cemetery plots. As long as it's not the life insurance contracts or collectibles, you're okay. But you have complete control and just a complete diversity of what you can invest in. That's what makes these such a powerful tool for the right investor. Now, if you thought, hey, I haven't heard of this, why now? Well, quite simply, what dominates the landscape with IRAs are really the big institutions, mainly your brokerage firms, your banks, and to a certain extent, insurance companies. And when you take a look, if you have those accounts elsewhere, they're basically selling you the products that they're able to sell. It's just simply they don't do self-directed IRAs the way we do because it's not their business model. But the IRS regulations allow for it. IRAs have been around for approximately 50 years. Same thing with self-directed IRAs. This is nothing new. It's not newly created. But a nice trivial fact to squirrel away in your mind, and this is the reason why you really don't hear about them, only about 4% of IRAs are truly self-directed. So it's a very small share of the market. Why would someone want to self-direct? Well, obviously there's tax benefits when you invest inside of an IRA. If it's a traditional IRA, you can invest tax deferred, pay taxes later when you withdraw the money. In the event that it is a Roth IRA, well, that's tax-free at distribution. But sometimes when people are looking to go into transactions such as real estate, for example, they typically don't think of using their IRA. They usually use cash out of their bank account. Well, you may not want to use that for whatever reason. Perhaps it's for your emergency fund or tuition for your kids. You just don't want to tap that money. So when the IRA now is understood that it could be a source of investment capital, it takes on a whole different look, touch, and feel, and of course generates a lot of interest. And we also hear quite a bit from existing clients. What really has attracted them is an alternative to the stock market. They're just tired of the usual tried and true stuff of stocks, bonds, mutual funds, ETFs, etc. They want to introduce other things, change their asset allocation, and hopefully achieve higher returns. And this is all possible with self-directed IRAs. For those of you that are interested in learning a little bit more about the subject matter, if you get on our website, you'll notice in the events tab, there will be a listing of all of our upcoming webinars. These occur weekly, twice a week, and they are done Tuesdays and Thursdays from 12 noon to 1 p.m. Eastern. We also have some monthly workshops that we will do. I think the biggest and most popular one is Pitch, Promote, and Prosper. That is typically done on the last Friday of every month. However, this month of November, we're doing it on the 15th. We just don't want to have a collision with the Thanksgiving holiday. But there are blogs, podcasts, etc. Please explore the website. Lots of educational and instructional material there. Now, if you do want to move forward at some point in the near future and get started, very simple. Just go to our website. On the front landing page, you can go to the portal to open your IRA, and it'll walk you through all of the steps on how to open, fund, and of course, when you find your investment, you just contact us and we will assist and walk you through in getting the investment made. It takes about 15 minutes to open up an IRA, and we do as much of the document signing digitally as possible. We believe in ease of doing business. Now, before I introduce our presenter for today, Trevor Thompson, who's with Massive Capital, Trevor and I were just having a brief chat a day ago. This is a great time to really get back to basics. We are in Q4, which is a planning quarter for businesses and investors alike. A lot of new opportunities could be presented to us in 2025, particularly with a lower interest rate environment and just with it being a new year in general. A lot of new opportunities to harvest. So I really want to get that focused and put in everyone's mind. But just before I turn it over to Trevor, you know, when you think about fundamentals, I can't think of a better person on that front than the old Green Bay Packers coach, Vince Lombardi. Back in 1967, when his team lost the NFL championship, 1961. This predates the Super Bowl. Super Bowl didn't exist till January 1967. When he had his team back in training camp in that summer of 1961, you probably have heard this quote before. He wanted to take the team back to basics and relearn the game of football so they could dominate it, which they did for the next 7 seasons. They won 5 championships over that time period. But the quote you probably all have heard, gentlemen, this is a football. So why don't we get back to basics? And I'd like to introduce the guest speaker, Trevor Thompson. Trevor, it's your presentation from here on out.
Awesome. Thank you so much. Really appreciate you allowing me the opportunity to be here. I always tell people that you want to move your funds into something self-directed so that you have a choice. And so today I wanted to do a very, as Ted mentioned, back to basics kind of what is passive investing. because it's very important that we think about it and kind of understand all the different nuances. So if we'll go to the next slide here quickly. I'm part of Massive Capital. These are the leaders of Massive Capital: Sanjay, Shirar, Mike. Bo is with the company Realty One we partner with. I'm on the investor relations side. My title is actually VP Investor Engagement, because we're really trying to create a community with lots of education, lots of engagement. And I'm joined by Maria, Jasmine, and Candace. A little bit of our track record at the bottom: 29 deals. We've done quite a few development deals lately. And again, past results do not predict future results, but we did produce an over 30% IRR. We built some retail, about $65 million worth, and sold it for 93. We do have just under 1,400 apartments under management, and we manage about $500 million in assets. So the company is called Massive Capital, and I refer to us as an entrepreneuristic syndicator. So that's kind of the way. And we're going to talk a little bit more about what is syndications and passive investing. So we can go to the next slide, please. So this is a little bit about our team that we have. So we're a vertically integrated real estate company. We're a developer of class triple net. So triple net is where the tenants are paying the expenses of operating their businesses. So they pay their rent, and then they pay all of the common area costs, which include taxes, insurance, upkeep, everything. We do a lot of town centers, and we're also an owner operator of value add multifamily assets. As you can see from the map, we are very Texas focused. I do live in Austin, Texas. Other partners live in Dallas and Houston, but we do have assets in Denver, Colorado, North Carolina, and Atlanta, Georgia. And we've been working on a couple LOIs in Phoenix and Tampa, more on the new build retail side. So you can see our partner, Realty One, and then Massive Capital. I've kind of touched about it, but we do land development, building construction, and building operations. Most of my role, as we go over to the left, is the LP equity. So we'll talk a little bit about LP equity. That's when you use the funds that are in your self-directed IRA and you invest them into a particular business. So we have either multifamily, new build retail, some development. We also have a brokerage company, land development, regular development, steel frame construction, and we do have a whole education department. So again, this little gives you an idea of the size of Massive Capital. Massive Capital's been around for about 3 years, but the partner themselves have been doing real estate for a couple of decades. Myself personally, I started out as a passive investor, and I'll talk a little bit about myself lately, about 6 years ago. So if we can go to the next slide. So why would you want to invest in real estate with your 401k or self-directed IRA? Okay, so again, these are a lot of the reasons why, right? Cash flow. Real estate is favored option and can provide a dependable source of cash flow through rental income that you can utilize without having to deplete your initial investment. Obviously, real estate has long-term appreciation. That is the real advantage of real estate. It can be used over time. They're not building any more dirt. It always comes, and so there's always a demand for something to be built. Leverage. So if anyone has ever read Rich Dad, Poor Dad, and if you haven't, I suggest you do, it talks a lot about how leverage helps you actually go ahead and buy something bigger. So for example, on a syndication, we may buy a $10 million apartment and have $6 to $7 million of debt. Then we'll raise $3 to $4 million from our investors. And so that leverage helps us be able to get a bigger buying power and to be able to grow the asset. There's also diversification. So there are lots of different asset classes that you can invest in. So again, I've talked about multifamily, retail development, and land development, but there are any number of things that you can invest in. And I know earlier we were talking about some of the things that you can invest in. I'm mostly focused on real estate, and so I've not done too many of the other asset classes. The most important thing I can tell anybody is diversification is very important. You want to make sure that you've invested in a variety of assets, in a variety of location, with a balance of risk reward, which we'll talk about a little bit later. Super important. And then obviously the reason we're all doing this is for tax benefits, right? So first of all, you're moving your retirement funds from someone that's an employer managed program, and you're putting it into a self-managed program. Therefore, you can determine where you're going to invest. Someone else doesn't do it. So, you know, traditional and your employer basically just plays the stock market, a few mutual funds or whatever it is, but you have a decision you can make of where you would like to put your money. And of course, I'm heavily involved in putting your money into real estate, but it is not the only asset class that you can use, as was mentioned earlier in the presentation. So if we want to pop to the next slide. So my goal, this is my goal, is to help 1,000 people reach financial independence through real estate investing. What does that mean? 1,000 people is a lot of people. And in fact, I spoke this weekend and somebody challenged me to change this number to 100,000. And I want to tell you why. I'm not telling you that 1,000 people are going to invest with me. That is not my goal. My goal is to educate people so that they understand the value and the power of putting their funds to work for them. We all know the great Warren Buffett, and he said, if you do not find a way to make money in your sleep, you will work until you die. Another very interesting thing about Warren Buffett that I learned not too long ago, I just turned 65. And it turns out that Warren Buffett, and we all know he's worth a couple of billion, made 80% of what he made after the age of 65. And I'm going to tell you why. The power of compounding your money. So earlier, I talked about the power of leverage. Today, I want to talk a little bit about the power of compounding your money. So let's use a very hypothetical situation. And again, I am not projecting returns, I'm just using this for an example. But if you were to take $100,000 and invest it into a real estate syndication, our goal is to double your money every 5 years. So think about this. Again, this is why you need to start early. Take $100,000 in 5 years, grow that money, it becomes $200,000. Reinvest that money, in 5 years, it becomes $400,000. Reinvest that money, it becomes $800,000. Again, do it again, 1.6 million, do it again, 3.2 million. Now, a lot of assumptions in my story, but it's a very powerful story to talk to you about how your money can compound if you keep your money working. So if you could imagine, if you were able to move some funds into a self-directed real estate vehicle like you can get here, and you were to continue to reinvest it, how many people do you think starting and growing $100,000 to over $3 million would change their lives? Now, I also talk about financial independence. Financial independence is different for every single person. It depends on where you are in your life, what your goals are, what your family situation is. There are a lot of variables, right? So someone's financial independence may be just to have the second breadwinner stop working and stay home with their family. It may be to send the kids to college. It may be to travel. It may be to retire early. It doesn't matter what it is. What matters is that you have the discipline to invest and let those investments grow over time until you no longer need to trade your time for money to keep doing what you need to do. Because again, we're all trading time for money right now. We go to work, they pay us, and you need to have your money go to work for you while you're sleeping so that you're no longer giving time to make money. So if we'll pop to the next slide. So understanding your risk reward with passive investing. I've got a couple of really, I'm going to call them out of the boxes of way to look at things. I like to think of things a little bit different. So we'll pop to the next slide. So if you could picture this, passive investing is very much like buying a ticket to fly on an airplane. I'm going to take you on a journey here. It's not necessarily a travel journey, it's a financial journey. But if you think about it, there's a lot of comparisons that are the same, right? When you go on a trip, are you buying an airline? No. Are you getting your pilot's license? No. Are you even learning how to be a mechanic to work on the plane? No. You're not doing any of these things, but you're trusting that somebody else is doing them, and somebody else is doing them to be sure that they protect your safety, in this case, protect the safety of your investment. So it's very important. Just think that through. Think about that you're going on a journey. So you've decided, okay, you're analyzed all the places that you're going to go, and you've made a decision to go on a financial journey. So just like buying a ticket on an airplane, you make a passive investment into a real estate offering. So you take your money and you say, okay, I'm going to give it to a third party, and I hope that my money arrives at its destination safely. So we'll pop over to the next screen. One of the things that's very interesting, as a passive investor, also as a passenger on an airline, you're not responsible for anything to do with operating the airline or the airplane. You simply buy a ticket with an airplane that you think is reputable and is going to get you to your destination safely. So again, your responsibility is obviously making sure that you give your money to an airline that's going to get you to your destination. Now, the airline industry is a lot more regulated than the investment industry. So you have a little bit more due diligence and a little bit more responsibility for making sure, right? Because we all know that the FAA does their best, and I believe they work hard to do it, to keep us safe. They want to make sure that all the rules are followed. It doesn't mean there are no rules in real estate or passive investing, but there's a lot of nuances, right? It's not like something that is the same over and over again, right? So Southwest, I fly Southwest a lot, and they've got series of destinations and they've got lots of things. And I'm going to be honest, when I fly, I feel pretty comfortable. So let's pop up to the next slide. So just like when you're making a passive investment into commercial real estate, your role in the transaction is very similar to buying a ticket on an airline. You literally have no responsibilities, all right? As a passenger on an airplane, if you showed up at the gate and they said, well, Trevor, I got to tell you, the pilot called in sick today, and I heard that you read the pilot's manual last weekend. Would you like to fly these 300 people to London? Well, I'd be a fool to say yes, that I'm going to do that, right? So again, when you show up, they don't ask you to do anything. They ask you to show up on time. They ask you to stand in line to board the aircraft orderly. But at the end of the day, you don't really have any responsibilities. You're not doing anything. You're not making sure there's fuel in the plane. You're not making sure the tires are good, that all the mechanics are good, everything. And it's the same thing when you make a passive investment. You invest, pay for a journey to financial independence. And again, we talked about it. Financial independence is what you decide it is and what you need for your family and for yourself. So we'll go to the next slide. So the general partners or the sponsorship team, they're responsible for finding the asset, arranging the debt, everything to do with the operations, keeping the investor capital safe while sharing in the profits. So I want to talk a little bit about it. So when you're investing passively into a real estate, there is this group called general partners or sponsors, all right? And it's normally a team. and the team has different people that have different responsibilities. We'll talk a little bit more about them at the end of it, but at the end of the day, they are in charge. They're the ones who are looking for the deals, right? Everybody wants a deal. Nobody wants to overpay. Nobody wants to have a higher interest rate than you can get on the market. So you are trusting that these general partners and this sponsorship team, they have the skill set. You want them to be finding the right asset, and you want to make sure that they have the correct debt that is appropriate for that asset, right? We all know different things. Some of the people, are talking the sky is falling. I hear from experts that about 4% of all multifamily are in trouble because their debt, with the interest rate craziness that's gone on, has changed the dynamics of the deal significantly. Thank goodness interest rates are coming down a little bit. But again, as the partnership team, you are responsible for doing everything. So again, I mentioned about massive capital. Within massive capital, we have people that look for deals. Those folks are on the acquisitions team. Then we have people who underwrite the deals. Those are the people that are saying, okay, if we bought it for this, we bought it for that, all of the different conditions, and if we could get this debt, this is what the numbers are going to look like. And there's a lot of data that goes into there, right? You need to look at the asset. You need to do a very thorough due diligence of the asset because you need to find out what gets fixed. Most multifamilies today are what's referred to as value add. So you're buying something that needs value added to it. So if we assume, okay, we can renovate these 100 units for $3,000 a unit, but it really costs us $6,000 a unit or $10,000 a unit, well, the whole plan is messed up. So we have to make sure that this team understands what's needed. When we buy apartment asset, we walk every single unit. We have photographs, we have a checklist. All right, the appliances, we basically have three things, right? They're in good condition, they need some work, they need replacement. We look at the walls, we look at all the electrical outlets, we look at the air conditioner units, we look at the hot water heaters, we look at the roofs outside, we look at the parking lots, we look at everything. So the sponsorship team is responsible to find it, and then they need to make sure that they have enough money to implement the plan, right? So when I mentioned before, let's say we're buying a $10 million apartment complex, it may need $1 to $2 million worth of renovations to it. We also need to make sure that we have some contingency money, some reserves, some different things. What if insurance goes up? What if this happens? What if property taxes? Big thing in Texas is property taxes. That's one of the ways that they collect most of their money here in Texas. So again, the sponsorship team is responsible to keep your money safe. That is their job. Their number one job should be protecting the investor's capital. And then when we're finished our journey, we share the profits with the investors. So if we can go to the next slide. So again, I got a lot of words on this slide, very much like an airline. Senior executives who operate the entire business, they are the same as the sponsorship team. So again, as the senior executives, is the main guy flying the plane? Chances are they're not. Is the main guy fixing the flat tire, putting fuel in the plane, doing all the things? They are not. They are responsible for a business plan. They're arranging, we're going to fly from here to there. It's going to take this much fuel. It's going to cost us this. Our gate fees are that. The lease on the aircraft is that. The cost of this is that. All of the different things, it's their responsibility to make sure that they have it. So the pilot, he's the person who's responsible for flying the aircraft. I'm going to refer them as your asset manager. They're the one that is managing. They are responsible for that aircraft. When that happens, that pilot ends up in control. When they walk through that little door and it opens up, the pilot is in control. And what the pilot is making sure is, does he have his team on the plane or the flight attendants there? Have the maintenance people done all of their checks? I don't know if anybody else has seen an aircraft, but I've seen the pilot crawling around outside and looking at different things to make sure it's done. That makes me a lot more comfortable than he's sitting in the cockpit drinking a cup of coffee. They look at their flight plan. They know, okay, we need to go here. Do we have enough fuel? Do we have this? Do we have that? Is all the luggage balanced? Are the passengers balanced? Everything. And then they have a whole support team, right? So there are people at the gate. Okay, they're kind of like myself that, I'm a combination of where you buy your ticket and then we make sure that you get on your journey correctly. So they're going to make some announcements saying, okay, here's what's happening. Oh, we've got a delay. We've got this, we've got that. And you want to make sure, again, that you're giving your money to a team that can take care of all these things. Then there are the people that maintain the aircraft and also the flight attendants. All right, so the flight attendants, they have a very specific responsibility. Now, at the end of the day, flyer passenger safety is their main job, but they do other jobs, right? I like to get my glass of water and my peanuts. We all do. We want to make sure that everything's happening. So a lot of those people would be referred to as the property management company. Again, when we buy an apartment, we are not there actually operating the apartment. We hire a property management company. So let's think of the property management company. It's kind of like the ground crew. They're the ones that make sure the plane is clean, make sure the plane is ready, make sure all the luggage gets on board, make sure that the fuel has happened, all of the different things. This is very much the same as the apartment complex. Now, what happens, right? The property management team, the ground crew, they report up to the pilot, right? They're always, they're always saying, you remember, you hear them, I'm waiting for this information, or I'm waiting for this person to check in to make sure this has happened or that's happened. So again, the property management company that's scurrying around, this is their expertise, getting the property ready for the residents, building something, doing something. And so again, that's a big team. And a lot of folks, we don't think of this when we're just putting some money in a real estate deal. We just don't think it through of what a size of a team and how important that team is. Now, I know a lot of you are probably been fairly sophisticated investors. I want to ask you a question. If your pilot said to you, well, last weekend I went to a seminar from a very famous apartment syndicator, and I went through the whole 3-day course, and I'm ready to take you on a journey. Do you think they're ready? I'm not sure they're ready, right? You want to make sure that they have all of the things that they've done, that they've been doing the test flights before they do a real flight. So there's a lot of things that you want to make sure that you are doing. That's your responsibility to find out, at least that you feel comfortable who you're giving your money to has all of these elements of a business in place. It's very different. A lot of people don't realize this. You're actually investing in a business that is backed by a real estate asset. So if we can go to the next slide. Again, as a passenger, they take care of everything. You just buy your ticket and go on a journey. Could you imagine if we were all got on an airplane and somebody said, oh, I'm sorry, the pilot's sick. Who could fly the plane? Who could make sure that we're done? You're just not going to do it. You want to make sure that you have a team that is taking care of everything. It's kind of funny. Look at this. Clearly, I used a photo from COVID. The guy's got a mask on. So we can go to the next slide. So again, while on the aircraft, just like a passive investment, you have no responsibilities. You can continue to work. You can get some work done. You can have some quiet time. You can take a nap. You can read a book. You can do anything. It's your decision. So again, what I want to talk about here is once you make your investment into a deal, you can ask questions. Excuse me, it's a little cold in here. Could you make it warmer? Excuse me, I'd like to get another glass of water. Excuse me, I need to get up and use the restroom or whatever it is. But at the end of the day, you're not doing anything. You are on a journey. You can't get out of the airplane until the journey is over. So that's another thing for you to make sure that you realize that these have a timeline, and until your journey is done, you can't do anything. But I also want to make sure, as a limited partner passive investment, you also have no responsibilities. The only risk that you have is the money that you've put into the deal. If something terrible happens, at the end of the day, it is the sponsorship team that is responsible for everything. They're responsible to make sure everything happens, and they're responsible if anything goes wrong. Now, again, when you're on the airplane, you want to assume that you're going to get some regular updates, right? How many people have been on a plane and the pilot says, hey, we're coming into an area with some turbulence. In a few minutes, I'm going to be putting the fasten seatbelt sign on. How many people appreciate that? I know I do. A couple times I've needed to go to the restroom and they didn't make that announcement, and then ding, the sign went on, and I was like, oh, I should have went. I'm stuck here. Okay, so again, on an investment opportunity, the sponsorship team is going to continually give you some updates. They often come monthly or quarterly. Some of them do biannually, but you want to get some sort of updates on the journey. Hey, we're on time, we're on schedule, and just like in flying on an airplane, a passive investment can have some turbulence. Things can happen. So sometimes they'll say, listen, up ahead is a big thunderstorm. We're going to fly around it. It's going to add some time to the investment. We're going to do this. We're going to do that. So again, you want to make sure that you are giving your money to somebody who is giving you these regular updates. So if we can go to the next slide. So I've said it a lot here. You put the trust, you get to your destination, get updates. I believe I actually overtalked in the last slide, and this slide is there. So we'll pop to the next one. Sometimes I get ahead of myself. So once you arrive at your destination, your trip is complete, and they'll say, thank you for flying this friendly skies. So again, on a real estate investment, there could be distributions during the period. There could be things that happen during the period. But at the end of the deal, when the deal is over, the trip is complete, and you will receive your portion of the profits, all right, which is why you invested in it. So again, you have no responsibilities, but they're going to tell you, hey, the trip is coming to an end. We need to get the seatbelts on. You're going to go down to baggage claim 3, and your check is going to be there. It obviously isn't. It's going to come on usually through an automatic payment to your bank account. So we'll pop to the next slide. Same happens when your investment sells. You receive a share of the profits, and your journey is complete, and you're ready for the next trip. So again, I want to remind you what I talked about before, ready for the next trip. You want to always keep your money moving. I am shocked when I hear somebody who says, oh, I've had 30,000, 50,000, 100,000 sitting in my account, and it's just been sitting there. If it's sitting there, it's going backwards. You want to make sure that you keep your money moving. Because again, on my scenario, if you miss periods of time, you remember going from 100 to 2 to 4 to 8, all the way up to over 3 million. If you were to take breaks in the middle, at the end of the day, you could be leaving up to $1 million of profits off of the line because you just didn't keep your money moving. So we'll pop to the next slide. So this is a very dense slide, but I want to go through it here. So you'll receive a share of the profits. It comes as the deal as excess cash flow. So the excess cash flow will be your quarterly payments when it happens, or when the deal sells. And splits are different for each investment opportunity. But I'm going to present a sample here that we use at Massive Capital as our most common way that we distribute funds. So 70-30 split. What does that mean? It means that 70% of the profits go to the passive investors and 30% goes to the general partners. So again, during a quarterly period, we make $1, and again, hopefully we make more than $1. 70 cents of that dollar gets split up by what the passive investors own, and 30 cents of that dollar gets split up between the general partners, of which they own the general partnership. Now, you may have heard of investments that have a preferred payment. And again, Massive Capital likes to offer a 7% preferred repayment. What this means is until you get 7% return on your money, and this is accumulated return. So again, if you put $100,000 in, until you've made accumulated of a 7% return, we're not eligible for any distribution. This is a very important thing to consider. We refer to this as an investor first approach. So we're going to make sure that the investors get some money back before we start making money. And what that does is it aligns everybody's interest. So it gives comfort to passive investors, but it also aligns the interest in once we've caught up, we're going to get paid. Because remember, that's how we get paid. So it works very well. And again, distributions, if they're made, are often quarterly. Some investments don't have any, they're limited cash flow. So for example, multifamily, storage, a lot of the investments may have some cash flow, but on our new development projects, they don't. Because what happens is we raise the money, we get the debt, we build the asset, we lease up the asset, and then we sell it. So there's sometimes not any profits during the period of the investment time. So the goal of a typical investment, very broadly speaking, because again, every deal is different, is to double your investment every 5 years. Now, some deals we have are 3-year deals. Some deals I've been invested personally are 7-year deals. So there are some different things. The most important thing is that you understand this. You don't want to get on a plane thinking it's going to take 3 hours to get there to find out it's going to take 10 hours to get there, because you're going to mess up all of your plans. So you want to make sure. Now, if I say it's a 5-year deal, 5 years to the day, we don't sell the asset. We sell the asset when it's achieved its greatest purchase value. It may be 3 years, it may be 4 years, it may be 6 years. And so you want to, again, make sure that you understand what is the realm, right? Because again, it's only a general. We're saying, hey, we think we're going to get you there, and this is what we're going to do. So again, always ask questions. Next slide. All right, so every investment opportunity has a different balance of risk reward, different projections, different timelines, different returns, and then different tax scenarios. So even within your self-directed funds, there's differences in the tax scenarios of, are you getting debt? Are you getting leverage? Are you doing different things? Are you with a Roth? I'm not a tax accountant and I'm not going to get into that. But what you need to understand is, what is my balance of risk reward? What are the different projections? I'm going to tell you, if the projections are too high, be nervous. My mama always told me, if something feels too good to be true, it probably is. So look for realistic, balanced projections from teams that have already been doing what they're doing. Again, if a typical flight takes 5 hours and airline C says, oh, we can get you there in 3, I'm not too sure if I want to get there in 3, because again, it's a 5-hour trip. What are they doing to get there? What risks are involved in getting there that quickly? So we'll pop to the next slide. So again, you want to make sure that you have a balanced portfolio. Risk. I know it's really hard when you're first starting out to understand risk. All right, so there are different types of deals that have different risk portfolios. So for example, some investments just have a preferred. I happen to actually have one through my self-directed IRA, and it's basically a debt, and they bought a medical center has a triple net lease. It's double guaranteed, so it's guaranteed by the doctor personally and by the doctor's practice. It's a very low risk, but it only pays me a 10% pref with no upside. But I'm happy because I feel really good on that. Some of my other investments may have a higher risk, right? They may think, okay, it's going to be a little bit more. What if we can achieve it? So you want the risk, you want the reward, you want to know the time. So when do you need your money to keep moving for you, right? You want to invest it in something that's a 1 year, a 3 year, a 5 year, a 7 year. And then again, you want to worry about or think about what asset classes. You don't want to only invest in one type of asset, I don't believe, especially when you start doing multiple. And you also don't necessarily want to invest in one geographic area. Now, personally, I invest in pro-landlord, business-friendly states. Doesn't mean that people out in California and New York are not making money. They are, but it's just my personal risk tolerance. So if we go to the next slide. So another analogy. So now we're playing baseball. So I'm taking you from airplanes to playing baseball. How many people think that people win the World Series by always trying to hit a home run? They don't. They know who their team is. They put somebody up to get on first. Then they put somebody else that can get on first and move that person to second. Then they try to put their big hitter in, and they go for try to get the bases loaded or try to get everybody home and get the grand slam. So again, it's just like your real estate investing. Don't put all of your money in a home run, and don't put all of your money on a single only. You want to make sure that you have a few investments. They may not have the bigger returns, but again, it's return of your capital is most important, and then we all want to make money on our investments. So try to balance it out a little bit. Now, I know as a new investor, it can be intimidating, so ask your sponsorship team questions. Ask different things. Hopefully they'll have a variety of investments, and then you can do it. But you want to make sure that you balance out your investment portfolio, especially as you get going. So if we can pop to the next slide. So important considerations, syndications are not liquid. You cannot get off the airplane. We don't give you a parachute and say jump out. You've got to go on the whole journey. These are not risk-free investments. You could lose some or all of your money in a deal. If it goes poorly, a good GP will disclose the risk, but also be careful to do your own due diligence and have backup strategies to mitigate risk. All right, so again, it's not risk-free. You want to make sure that you're giving your money to somebody that you know, like, and trust, and you've done some due diligence on them. LPs do not have any control of decisions or timelines. You can't call up the team and say, hey, you got to sell that apartment complex. Little Johnny's going to college. Nobody's going to sell it so little Johnny can go to college. The GP team operates the property, and they decide when and whether to sell. Now, if you think backwards, interests are aligned, right? You make 7% first, we get 30% of the proceeds. We want the sale price to be as high as possible while balancing that risk and reward. We may want to sell now because we're worried what will happen in a year. We may wait a year because we're worried about what's happening now. So again, you have no decisions. Your money is tied up. You cannot move it out. Next screen. So again, I'm going to go through this pretty quickly because this is sort of heavy, but basically they make an LLC structure which sells security, which means SEC rules apply. In most cases, limited partners must have a pre-existing relationship with the general partner. That's on a 506B syndication where we can't advertise it. We have to have a one-on-one relationship, and limited partners can be either accredited or sophisticated on a 506B. If an offering is a 506C, all investors must be accredited and you can advertise. Now, I do know if you're accredited, your retirement fund is also accredited. What that means is you have $200,000 annual income for an individual or $300,000 for a spouse, a net worth of $1 million, net worth not including your home, all other assets are included. One thing that's super important to know, there is no difference on 506B or 506C. The only difference is who can invest and can I market the deal to the general public. So that's the only big difference. So we get to the next slide. So this is me. Just so you know, I've been a limited partner in 20 syndications, a sponsor in 12. I love talking about passive investments. I'm so thankful that they've allowed me to come here and speak today. Hopefully I've shared something that's of interest. I'm not sure how we do Q&A, but I'm ready when you're ready.
Okay, Trevor, great. Appreciate the presentation and the dialogue. I'm going to take us off of this slide. And for those of you on the webinar, if you will please, if you have a question at the bottom of the screen, there should be a box. Just type in your question there. I'll see them pop up on my screen. And I will ask those questions of Trevor. But while we're waiting for a few questions to come in, Trevor, I know you and I were talking yesterday, about your airplane analogy and how much training pilots go through to avert disaster. Really their professional risk controls.
Yeah.
Can you talk a little bit about that with the different investments that you're dealing with over at Massive Capital? What do you do to prevent a disaster?
Yeah, so again, it's the power of a team, right? Making sure that you have really good people on your team. We actually underwrite like over 100 deals a month. And out of that, we probably make 10 offers. And, out of all that, if you think about that, that means we've made about 120 offers and we ended up getting about 5 or 6 deals out of that. So there's a lot of work that goes into it. Just making sure that you're paying the right price for the asset. You've done all of the due diligence. And then, sometimes we had a deal not too long ago and something changed in the deal and it no longer was a good deal for our investors. We walked away from the deal. We lost almost $100,000 of our own money, but that's so important, so much better than taking the extra risk. So you want to look for a team that will talk to you about those things. What have you done? Why have you not done certain deals? Really get to know your whoever you're going to give your money to. To me, that's the most important thing.
Okay. And how about when you're in a deal, say, I know you mentioned these run about 5 years. What if you're in year 3 and things begin to go sideways?
Yeah, so as a passive investor, all you can do is ask, what are you doing? Like, how are you fixing this? And sometimes things do go sideways. I'm not going to lie. I want to make sure that I'm honest with your audience. But again, you want to make sure that the team has experience. They've made sure that they've made a good plan that has reserves. So again, it's just like, think of it your family, right? I got no money in savings. I got a ton of credit card debt. And if one more thing happens, the car breaks down, I'm in a disaster. Well, we have to have a plan just like that, right? So we have reserves, we have cash flow, we have different things. Our owners have to be somewhat liquid so they can help through anything that happens. You also have to make sure that you're working with good qualified people, right? We don't look for the lowest insurance price. We look for the best price with the best provider. And so you want to make sure you go through all those things. And then, I'm going to be honest. If somebody's been honest to you about their struggles, chances are they've got the experience to get out of it. Like if you've gone through something that's been hard and a deal's been a struggle and you're honest and you share that with people, I think that's super powerful and that's who you want to look for.
Great. And one thing I'm looking forward to is 2025. We've got interest rates declining a little bit. We've got an election that's been decided, and here we are. Everyone's doing their investors and businesses are doing planning, looking forward. What are some things you're looking forward to for 2025?
So I think we are in one of the biggest buying opportunities that have ever existed, at least in my lifetime. There are a lot of things, when you think back to the crash of 2008, that had actually nothing to do with commercial real estate. The delta between what rent costs and what home ownership costs has never been higher. And so if you can buy multifamily assets at the right price, at the right value, with the right debt, there's a huge demand for housing. And then, I live in a high growth state. So, building new developments where people are moving to is also a powerful thing for us to be able to do. We have to live in a place, obviously Texas is really growing.
Good deal. All right, let's see if there's any other questions from the group. If you do have any questions, please enter them now because we're getting close to the end of our time here.
I do have a funny joke about Texas. So,
Go ahead,
Elon
shoot.
Musk has moved X space and all his things. So now all of Elon's exes live in Texas.
Like that old country song. Way cool. All right, Trevor, it looks like we don't have any further questions today.
Awesome. Well, hopefully that means I did a good job and folks learned something.
I think so. You covered a lot of bases. I mean, our conversations in the past, you and I talk about syndications, and I always have questions, and I don't today. So I think you covered everything.
Perfect.
So
Awesome.
if no one has any other questions, I just make a motion that we bring today's webinar to a close. Anyone
Awesome.
willing
I
to
really
second that?
appreciate the opportunity.
All right, good deal. Trevor, thank you very much. To the audience, thank you for spending the time with us today, and we look forward to seeing you on future webinars. That brings everything to a close for today. Thanks.